Good morning and welcome this morning to Protective Strategies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and the senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend, James Boyd, also an education coach and phenomenal educator in his own right. He's there to help answer questions specifically about this class in the chat. Thanks for joining us, whether you're joining us live or in the recorded version. We appreciate you being here. We are grateful to have you as clients and as attendees in this webcast today. And we're going to talk about protective strategies. We're going to talk about some of the circumstances that might trigger us to consider putting on a protective strategy, number one. And number two, we're going to talk about the idea of adjusting a couple of the protective strategy positions that we already have on. And I didn't pay Greg to ask a question in the chat this morning that would really kind of fall right along the lines of what we're doing today. But nevertheless, he did anyway. So he gets 1,000 bonus points that don't mean anything. But thanks for Greg for being there in the chat. We appreciate you doing that. We're going to talk a little bit about the reason why you might close a protective strategy position and move on, as opposed to rolling that protective strategy position down the road to keep the protection on. And so we'll see what that looks like as we get into this discussion. A couple of quick things, though, a couple of quick housekeeping items this morning as we talk about this. Everything we talk about simply for illustrative and educational purposes only. It is not a recommendation or advice or solicitation of any or endorsement of any particular security pattern or strategy. Also remember that Schwab does not recommend the use of technical analysis as a sole means of investment research. Now, since we're going to be talking about options, remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions. Spread trading must be done in a margin account. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It's not a guarantee future success. It's a great sandbox to learn, but it does not do some things that live trading accounts do. It does not facilitate the early assignment of short options. And remember that anytime you're short an option, if it's an American style option, there's a potential that that option could be assigned early. Remember that investing involves risk, including the loss of principal. Also remember that any type of analysis, including probability analysis, fundamental analysis, those are theoretical in nature. They are not guarantees as to what the price of the stock might do or what the market might do. Past performance of any security strategy doesn't guarantee future results or success. Hey, and if we talk about stop losses today, remember, stop losses and stop limits do not guarantee the execution price. They simply specify the activation price, and in the event of a stop limit order, there's the potential that the price of the stock could gap around the limit area, and that price could not fill at all. So let's take a look at where we are headed in this discussion. We'll talk a little bit about some of those protective strategies. We'll discuss some of the protective strategy applications that we have on right now, and we'll look at some specific examples. And as we do that, I'm going to shift my focus out to the Thinkorswim desktop software platform. And this is a good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. That's going to remind you to pop into that. That's going to remind you to click on that subscribe button, which is going to keep you connected, to the Trader Talks webcast page. It's a great way to stay in touch with that content, whether it's new content, whether it's archive content, and it pops it up into the top of the YouTube feed. So, and it's best of all, it's no cost to you. So click on that subscribe button. All right, let's take a look at what's going on in the market today as we start to look at this discussion. Taking a look at the SPX, starting to see the SPX earlier this morning. We were seeing the SPX right back down on that support level. We saw that little bit of a bounce as the market opened, gap up. Well, not really much of a gap, but a gap from the close yesterday up off of that support level and a little bit of a move higher, still staying in a very narrow range. I mean, you look at the range that the market has been in the last week or 2 weeks or even 3 weeks, and we've been up off of this support at around the 58.78 mark, up through the resistance at about the 6,000 mark, and then up to that 60.91, now down, and then back up again a little bit. We're at 60.83, just tickling underneath that movement and that little bit of a resistance level there. The 50 period, or in this case, the 50 period simple moving average still rising, 200 period moving average still rising. The one circumstance, and Dragon Rider, I've got 4 screens here. The one circumstance that is giving me a little bit of a pause here, or at least it did this morning, was the move to the downside in the RSI. We've talked a little bit about the RSI. It's a lagging indicator. It's got a look back of about 7 days. So it's got a lag of about that time frame, about half of its period, as typically oscillating indicators do. But in this particular case, we started to see that pullback coincident with the pullback in price towards the support level. That's broken the most recent trend line. We look at that most recent trend line back into the October timeframe, kind of back into the end of October. And it was that break in the RSI and that pull back into the support level that really was kind of a concurrence of kind of maybe that little bit of a change in what's going on, right? So to avoid singing the song from a popular Broadway musical, and soon to be part 2 of a very popular movie, something has changed here, right? I don't know that it's changed for good. That's the question, right? Something's changed in this push to the upside. We've seen a little bit more of a move into the downside. So we have a little bit of a divergence going on. Although not much of a divergence, because we have a higher high and a lower high at the moment. We have a higher high and a lower high in the RSI. But I would argue that if we were to look at this in aggregate, right, this kind of sideways move in price relative to the lower push in the RSI, right, kind of consecutive lower highs in the RSI would suggest that maybe we're starting to see a little bit of bleed off in momentum. Not that we're seeing necessarily a change, right? Maybe just a sideways pause, not necessarily reversal. It's got a long ways to go before we even get to the 50 period simple moving average, or this previous low that would be a change potentially in the trend. But we saw this once before, which is interesting, because if we go back into this October timeframe, you see that same kind of break, that same kind of lower high in the RSI, similar look in the price movement as it ran up from a support level towards a previous resistance, and then we saw a break of that support back down to the 50 period moving average, right? So not the history, we know, we know that history doesn't repeat itself, but it's sometimes, as Mark Twain so famously quoted and put out there on his Twitter feed, X feed, that history sometimes rhymes, right? Speaking of X, you can follow me, you can follow James on X. I'm at Ben Watson CS. James is at James Boyd CS. I don't know what Mark Twain's actual X handle is right now, but I'm guessing that Mark Twain probably has a blue check mark for being authenticated and validated. I'm joking, in case you hadn't caught that. Anyway, so as we're starting to see this pullback, this could be cause for putting on some protection, right? Because that possibility of a pullback back down towards that moving average, right? We're coming up towards the end of the year. Maybe we get a late Santa Claus rally. Maybe we get a push into the end of the year. There's likely to be some rebalancing for sure. And if that's the case, then we might see this pull back to that 50 period moving average. Now, that might be a reason for some individual positions to have some protection put on, right? For the sake of taking advantage of that relatively inexpensive protection at the moment. We'll take a look. Take a look at the NASDAQ. We're seeing the same kind of thing, although not the same type of real break in the RSI trend. And we're seeing a break above a resistance level in the NASDAQ. So the NASDAQ looking a little bit more bullish than the broad market. Russell 2000 looking a little bit less bullish than the broad market. And in fact, doing something, the same kind of thing, right? I'm going to activate this diagonal trend line. I'm going to draw that up. We saw a couple of days ago a break in that RSI trend line, and we see that pullback. Now, you could look at this as maybe a bull flag. We were looking at that kind of cobra pattern right there, that descending triangle at the top of a run, as an indication of maybe a possible move to the upside continuation pattern. In this case, it looks to be a bit of a reversal pattern, unless we get a close above the high of the low day, which we haven't yet, and seeing that evidence of a move higher. But we're not there yet, okay? And as we look at this, small caps obviously going to be probably the biggest, are going to take the biggest impact from any changes in interest rates. They're going to take the biggest impact from Fed action, from inflation information, and so forth. So that's maybe why there's a little bit more volatility in the Russell 2000. But let's take a look at, speaking of volatility, let's take a look over here at the VIX grid. And this is the chart that I wanted to look at just this morning as we start to see this move. So this is VVIX, volatility of VIX, right? So this is the VIX of VIX, if you want to think about it that way. If VIX is the relative volatility of the S&P 500 over a 30-day look back, the VVIX is the relative volatility of VIX over that same time frame, right? And so when VVIX is rising, that suggests that VIX options are getting more expensive. When VIX options are getting more expensive, that suggests that there is more volatility potential out there, or there's an expectation of future volatility. The VIX is a forward-looking instrument, even though it has a look back, right? It is an expectation of what might happen in the future, even though oftentimes it's used as kind of a shutting the barn door after the horses run out. So this is an indication where the barn door could still be closed because the horse hasn't run away yet, but the barn door is swinging open, right? It's swinging back and forth. That's where the VVIX is rising. Institutional investors, by and large, the ones that drive the VIX, they're starting to buy more protection potentially, and or maybe buying more speculative upside potential as well. Overall, though, we're seeing the volatility of VIX rising. But if we go to the VIX itself, right? We go to the VIX itself, it's interesting because we see, again, kind of this move back up into this 14 handle. It's bled off back down into this range, in about that 12 or 13 range, but now coming back down again today. So we're seeing volatility bleeding off. You can see how close it's getting. You can see that the 30-period average of volatility is falling. So what does this mean? Well, it means that right now still there is relatively inexpensive protection, right? We're not spiking way up here, right? We're not even up at the average level of volatility. And what that means is then some of that protection is still inexpensive, but this chart suggests that it may become more expensive quickly. Oftentimes, when we see disparity, when we see this divergence between VIX going lower and VVIX going higher, that can mean a move to the upside, right? It is one of those scenarios, right, where we've seen, kind of that divergence of the two leading to a higher move in volatility, which would mean that protection becomes more expensive. The barn door becomes harder to close because the horse is already sticking its head out through the barn door, right? So let's look at the positions that we have currently. Number one, that may need some adjustment to protection that we already have. Number two, let's look at positions in this portfolio that we've got here, and talk about the reasons why we might put protection on right now. And I'm gonna call back to something that James has talked about, not only in this particular class, but some of the other webcasts that he has talked about, where he's put forth the idea that we don't always have to put protection on everything, right? We don't necessarily always protect our entire portfolio. We protect the things that are most expensive, right? So, if you're like a lot of people, you've got maybe you have a nice car and you have a not so nice car that you use for taking, things to the dump or going to the Home Depot and getting, those types of things, whatever. And so you might protect those differently. Same thing might be true of the positions that we have in our portfolio. So uh, we might think about it from that particular perspective. So let's go over here to the monitor tab and let's take a look at some of these protective strategies that we currently have on. So I wanted to look at this in a couple of different ways, right? We've got two columns in this list of protective strategies positions. And I've got two columns that I think I want to focus primarily on in this case. One is total cost, right? So the total influence that position has in my portfolio. And the other is P&L open. And that's kind of that confluence of those two. So P&L open, we might think about, well, that's how much it's cost us or it's making us since we put the trade on. And I've got a couple of positions here that have been losing money. Most of them in this case, and again, this is not a guarantee. These are simply illustrative examples, but I've got two that have been costing money, that have been losing money. And it just so happens that the one that's losing, one of the ones that's losing in this particular case, is also the one that is the most significant cost in this portfolio. Meaning I have the most number of shares, or it's the highest share price times the number of shares. So the total cost is more significant than the others. The others are smaller positions. And that happens to be McDonald's. Speaking of McDonald's, if you want to make James happy for Christmas this year, a McRib gift card. I'm just kidding. Don't send James gift cards, please. He doesn't need another McRib. They're good, though. I'm just saying. It is McRib season. All right, let's take a look at McDonald's here really quickly. And by the way, speaking of McRibs, we've got McRib for you, which is our feedback survey out there in the chat. James is going to pop that up to the top of the chat so that you can get to that. But that's how we make these sessions better. So we're going to take a look at this McDonald's position in this particular case. And in fact, we've got a collar trade on this McDonald's position. And this collar trade is kind of a long-dated collar, right? We put this collar on for minimal cost, right? We put this trade on, and the put option cost is $5.25. And the call option, the short call option, brought in about $5.10. So we got this collar. We put this collar on, right? Selling the call option, buying the put option. Wow, they're defensive of you, James. That's amazing. We put that on for 15-cent credit. It's now trading in this particular case at $2.80. So look, if we were going to look at taking this trade off, we'd have to buy it back. Wow, it's costing us money in this particular case. But the question might be, is there a reason to take this trade off? Because this is the one that is perhaps the most in need currently, because it's the largest position. It has a loss of keeping that protection on. So I'm going to go to the chart really quick. We're going to go to our single grid. And we're going to pop up McDonald's. So I'm going to go to the style here. We're going to load up our style, which is our single grid style. There we go. We'll bring up McDonald's. Wait, JB can handle it? Okay, fine. All right. I'm also going to put on here RSI. RSI. We'll put on RSI into this chart. And we'll click on apply and OK. And here's what I see happening. I see McDonald's kind of running to the top of this resistance level. And I see this kind of running right back down off of that diagonal trend line on the RSI. So RSI kind of echoing what price is doing fairly consistently. We're not breaking out to new highs, but we're not breaking down below a support level. We're not necessarily breaking a trend line. If anything, it's kind of going sideways at the moment. So we're just going to maybe keep this going. So from a technical analysis perspective, to go back to Greg's question, if the technicals support what we're doing, the trend is still moving, is it more profitable to roll the combination out, or is it more profitable to close the combination down? So here's the thing that I might argue in this particular case. If we were going to close this combination down, we go back to that monitor tab, closing the combination down in this particular case would suggest that we have to come out of pocket to buy that combo back. Because what's happened is the put has gotten a little bit less expensive and the call has gotten a little bit more expensive. We're not at the call strike yet. Stock's currently trading at $2.99. There we go. Oh, so here's the thing. Rolling that call option, what we might be able to do is roll that call option to an at the money strike, maybe, or even a little bit further out of the money, give it a little bit more room to move, and maybe roll that at a credit. But here's the thing, we got 72 days to go on this, right? Yes, we will imagine. Of course, we can't accept that. I did not mean to intone that you should send us any kind of gift cards in any way, shape, or form. Don't send us any gift cards. Don't send us any gifts. Just virtual, thoughtful McRibs. There you go. Thanks, James. All right. But let's see what we might do with this particular position. It's got 72 days to go until it expires. So if we were buying it out, if we were going to buy this back, we got to come out of pocket. The question is, does this have the potential to go to the downside? And the answer is probably yeah, right? So we got a little bit of time here. Implied volatility's probably gone up a little bit. If this pulls back a little bit, then that might be the time to buy back the call option and eliminate that part of the obligation, right? If that call option gets a little bit less expensive. The put option in this particular case, we go back to that put option at the 285 strike, that 285 strike is kind of right down here, right off of that low. So what we might consider in this particular case doing is maybe kind of rolling the whole thing, rolling the whole thing up a little bit so that we've got a little more headroom for this to move to the upside and a little bit higher protection. That might be a potential possibility here in this scenario. We got 72 days to go until expiration, so there's still a lot of extrinsic value in this caller trade. So if we were to right click and create a rolling order, so let's roll the call first. Maybe we roll that call up a little bit. We're rolling out for time here. If we could roll that out and maybe up to maybe the 315 strike, and we roll it out a little bit more in time. See, now we're doing it for a credit, right? We roll it out to June. That's a long ways out, though. I don't know that we necessarily want to hang on to that protection that far out. If we roll it to the 21 March, we can roll it for, see, we're still going to have to pay if we roll it that far. What if we just roll it, if we roll it to another week at the same strike, we're going to bring in a little bit of a credit. So we extend that out a little bit. So let's do that. I'm going to extend this out another expiration cycle. That's going to be out to the 21 March. So that's going to keep that in place at the 210 strike. And then if this breaks through that previous resistance, we got a little bit of headroom for this to move to the upside. So I'm going to go ahead and we're going to click on confirm and send. We're going to read through this order, make sure that we're aware of that. Remember, rolling is not a magic wand. It requires a liquid market in the target, expiration, and strike. It doesn't eliminate any transaction costs. So we're just going to roll this out. We're going to click on send and fire that order off. And we rolled that out. We brought in a little bit of a credit. Now we've got $1.30 against that $2.30 cost that we had before. So what we now potentially could do is roll this put option out, right? Which is just what's sitting out here at the moment. We could roll this put option out. And that's become a little bit more expensive, which is good. Because if we're going to roll this, we're going to create a rolling order. We're going to roll this out to the 21 March. And we might roll this up a strike. So it's going to cost us a little bit more to roll this out a month but we're going to roll it up a strike. So let's kind of roll this 285. Let's roll this up to the 290 to give us a little bit more protection. So that's going to roll it out for a $2.40 debit. But remember, we brought in that $1.30 credit against that. So that's going to offset a little bit of that cost. So what we're going to do is this, again, not cost free. We've got to remember that this is for protective purposes. And because this has the largest potential loss, because of the size of the position, that's the reason why we are making this adjustment. I'm going to go ahead and click on confirm and send, and we're going to read through that order. Make sure that we're aware of that. Again, remember that the roll is not a magic wand. We're going to roll that out. And now what we've done by rolling these two, and we did it leg by leg, right? We rolled the call first. We rolled the put second so that we could collect that credit. So now here is what we have. We have 100 days to go until expiration. And we've got a long put that costs us $6.85. We've got a short call that we brought in for $8 that we basically sold for $8.15. So we accomplished that. If we were to think about the math here, right? So think about what this roll ultimately nets for us, right? So we sold the call for $8.15. We bought the put for $6.85. So let's do that. $6.85 minus 8.15. So there's our $1.30 of credit, right? There's our $1.30. Okay, so that's cool. We moved that protection out. We bought that protection or adjusted that protection so it's a little bit further out. We ultimately adjusted, other than that short call strike, we adjusted this so that, here's the 310. We've now got our protection here at 290. Our put is now below what is probably a more recent level of support. So we've kind of brought that in a little bit. So we've tightened the collar just a little bit, right? Just a little bit in terms of adjusting that trade and kind of extended that protection. So there you go. Okay, so now let's take a look. Let's take a look at the next position in this list, right? That's McDonald's. So the next position in this list is kind of the confluence, one that is losing money at the moment. It's this Williams-Sonoma position. So let's take a look at that one. Williams-Sonoma, we've got a long stock position in Williams-Sonoma. Okay. 100 shares. We bought it for 203. It's now trading at 190. And Jim, I'll answer your question. Yeah, let's do it. Let's look at Williams-Sonoma. Now, look, I know everybody thinks, wow, Williams-Sonoma, Christmas time, holiday season, it's, we see some moves to the upside. We saw a big pop to the upside in terms of revenue. And that popped the price of the stock well up here. But when you look at our existing position, Williams-Sonoma, we bought it for 203. It's currently trading at 190, right? Here it is at 190. We bought it at 203, which means that we bought it probably a ways ago. We actually probably bought it at the split. I'm guessing pre-split, and it just didn't adjust. But let's think about this, what we might do with this particular position at this point. Now, again, that's another thing really quickly, guys, that paper money is not really good at. Paper money is not really good at adjusting split prices. So it may very well be that we put this position on. Let's just take a look. When did we put the position on? Oh, we put that back on in January. So yeah, that was pre-split. And so it's very likely that that's a reason why we're seeing that position in the position that it is, right? So if we were to think about this, if that didn't adjust 203, we split that in half. That's about that's about 100 and what is that? About 100 and a half. Let's see, 100. Let's see. Yeah, let me just do the math. 203. If that's what we put the position on, 203.39 divided by 2, which means that our effective cost post split was 101.69, and now the stock is trading. Williams-Sonoma is trading at 190. So we've got a pretty fair run to the upside. So this is kind of a misnomer. And again, that's a function of paper money, right? So, but at the same time, it is a stock position that carries with a fair amount of weight in our portfolio. So let's take a look. We got the chart moving up. We've got a bit of a divergence going on in RSI. Now, it's not breaking down out of that overbought range, but it is running up to a high. And we do have a pretty clear level of what was previous resistance, maybe acting now as a new support right about here. And the answer to we might ask the question, well, is it time to exit this position or is it time to put protection on? And I would argue that maybe it is the time to put some protection on when that protection is relatively inexpensive. So we might go about doing this a couple of different ways. Let's see if we can do this in a no-cost collar. We want to protect perhaps at that level of support, right around that 178 mark. So I'm going to go to the trade tab for Williams-Sonoma. And unfortunately, Williams-Sonoma is one that doesn't have weekly option expirations, which means that there might be not quite the same amount of liquidity for these options, something we have to pay attention to when we're looking at putting protective positions on. But let's look over the horizon here. We'll go back over to the chart. We just had an earnings announcement in November, December, January, February. That means we're going to have another earnings announcement sometime in the February timeframe. So we go over the horizon here. We argue that maybe in that February timeframe or into the March timeframe, that's going to be where we're going to see that earnings announcement. So what I may want to do is kind of split the difference. I'm going to go to the 21 Feb. We're going to protect out for about 72 days in this particular case. We could go shorter, but not a lot because we don't have a lot of granularity there. So we could go out and we could buy a protective put. We might look where that level is. We said was at 178. So let's go back to the trade tab, 178. That means if we were to buy the 175 put option, right? 175 put option. We've got about 40-cent wide bid-ask spread. I'm okay with that because, again, we don't have a lot of choices here. So I'm going to go out to that 175 put. I'm going to look at buying that 175 put. If we buy that 175 put, that's going to cost, in this particular case, just about $5, kind of at the midpoint, right? Maybe $5.10. Now, if we go over to the left-hand side, to the call side, and we look out at about that 210 strike, which is about the 30-cent delta, that's going to be about the equivalent in terms of selling premium, right? So we look at the chart, and let's just cross-check that 210 strike against where the price of the stock is. Well, the stock's at 190, so that would give us 20 points of headroom to the upside if we were to sell the 210, right? So what's our expected move in that time frame? Expected move is about 25 points. So that's kind of within that 25-point expected move range. I'm okay with that because then we have the opportunity to adjust. But if we were to look at then selling, we're buying the 175 put. That's our protective put if the price of the stock goes down. It's out of the money. It's at or below a level of support, which might cause the price of the stock to bounce. That's fine. And we're going to look at doing this by selling a call option out in time. We're obligating ourselves here to deliver the stock if it moves to 210 or above and we get called away, we get assigned, and we're doing this for a little bit of a credit, right? We're doing this for about a 15-cent credit. So this is essentially a no-cost caller trade designed to protect that position that has run to a new high. Those calls are expensive. The puts are relatively inexpensive. And so we're able to sell further out of the money, give it more headroom than we are able to buy the put option, even though the put options are relatively inexpensive. So we're creating that low-cost collar. And again, you got to remember, this is, even at a low-cost collar, it can move like the one we did at McDonald's if the price of the stock moves. And a low-cost or a no-cost collar, if we don't manage it, can become expensive to exit if the price of the stock moves against us, or it starts to move towards that long strike or that short strike, the short call. So we got to pay attention to this. None of these trades are ever set it and forget it type trades. So I'm going to click on confirm and send. We're going to read through this order. We're going to make sure that we're aware of that and the transaction cost. And we're going to put this combo trade on. That's the caller trade. And so I'm going to go ahead and I'm going to fire that order off. And we're going to make sure that that goes into our protective strategies group. We're going to fire that order off and send that off. Okay. So that's what we've done now so far. We've protected this for a credit of 15 cents. And so now that position is in place. Let's go back to the chart. I'm going to turn on our show orders and trades here. Let's see if we can turn that on. Okay. So we've got those two positions here. Whoops. I think what I've got to do is go show orders and trades. And show orders, show trades, apply, and okay. And then I got to go back and do it again. Let's go show orders, show trades, apply, and okay. And I don't know why it's not showing up on here. Huh, interesting. All right, so, but that's where we would look at where we've got that. We've got a 210 strike call. We've got a 185 or 180 strike or 175 strike put option protecting this this trade at this particular point, right? So now let's go back over to that protective strategies page, and let's see if there's something else that we need to manage in this portfolio. We've got Coca-Cola, which has a long put, 9 days to go until expiration. We put that long put on to provide protection, and it is currently trading at 6 cents. So this is another scenario. I'm going to go back and we'll bring up Coca-Cola, KO. And Coca-Cola kind of bouncing up off of the support level. Now, there's a couple of things that we might argue in this particular case. Let's go to RSI. And click on apply and okay. RSI is rising. We've got a little bit of a bullish divergence here. We've got RSI moving to new highs. We've got price moving to a lower high. So we've got a bit of a bullish divergence as this comes up off of that level of support. We've got a put option in this particular case in this trade at the 60 strike. And the 60 strike is way down here. So in the event that this doesn't move, what we might do is roll that put option up here a little bit to just below that 62 support level. So I'm going to do this to give us some protection in the event that this rolls back and doesn't make the breakout of this W pattern. And in fact, this becomes a move to the downside. We're going to go back to this monitor tab, and I'm going to roll this out, create a rolling order. We're going to roll this out in time, and I'm going to roll it out in time and up in strike. So I'm going to go to my long side, and I'm going to roll this up a strike. We'll roll that to the 62 strike. And I'm going to do that for about a 27-cent debit. So I'm willing to pay about 27 cents to roll this out in time a little bit and roll it up and strike. So we're going to go ahead and click on confirm and send. Again, remember that this does not a magic wand, doesn't take away any transaction costs, but what we're doing is kicking can down the road and kicking it up the road a little bit as well. We're going to click on send. We're going to fire that order off. And now we've adjusted that put option so that it is sitting at the 62 strike. There it is at the 62 strike right here, which is just about that level of support. And that's what we're looking at as far as, oh, yep, exactly. Do not show. That's where I've got it. Okay. I know, because other people have been using this, and so that's why I think it's kind of messed up. Anyway, here we are. Got that level of support. We've got our put option. We've kicked the can down the road a little bit. We've pushed the protection out a little ways into the end of December. And if this doesn't break out through that resistance level, if that RSI divergence doesn't come to fruition, we've got a little bit of protection there, and it's a relatively small cost, but it is a cost, and we've got to pay attention to that. So what we've done today is we've managed our McDonald's position, which was the one that was in the biggest need. We managed to put a collar on our Williams-Sonoma position, and we adjusted this Coca-Cola position as well. Guys, if you want to learn more about these strategies and others, pop on over here to Schwab Coaching and jump into the live webcasts. And if you want to learn, if you want to search for a particular topic, by the way, speaking of that, what I do want to mention is that coming up next year, what you're going to see is that this class, same time of day, changes names and changes focus a little bit. We now become trading index options. So the primary focus is going to be using index options. And we're going to talk about different strategies using index options. We're going to talk about short dated index options, including 0 days till expiration index option trading. We're going to also talk about using index options for protection and protective strategies. So we're going to roll all of this into the new name for this class, which is going to be trading index options. Nothing else really is going to change other than we're going to focus not on using futures for protection, but we're going to use index options. It's going to be all index options. So rather than protecting individual positions, we're going to look at protecting portfolios. We're going to look at trading those even if it's not a protective strategy. So join me for that. That's coming after the first of the year. And as we get into that, that's a great way to kind of learn more about those strategies and some of those other strategies, including 0 days to go until expiration. But if you want to learn more about this, protective, and also the archives will live on. So you'll see all of these archives. They'll be there. And you can go right here to the Trader Talks webcast page. Click on subscribe if you haven't already. Fill out that feedback form for me, please, if you wouldn't mind. That'll be a nice little McRib for us. And guys, have a great day. We will see you again soon. Some of you I'm going to see in Houston this weekend, and then some of you I'm going to see in Dallas after the first of the year. And have a great day, everybody. We'll see you soon. Take care, everybody. Bye-bye.